In today's video, we'll explain the RobinHood trailing stop loss feature. A trailing stop order lets you track the best price of a stock before triggering a market order. Essentially, in basic terms, this feature allows you, the investor, to limit their maximum possible loss. With a trailing stop order, the trailing stop price follows or trails the best price of a stock by a trail that you specify. This may sound confusing at first, but we will break it down in an example and you will see it's quite simple. Essentially, if the stock price moves in a favorable direction, the trailing stop price will move with the stock. But if it moves in an unfavorable direction, the trailing stop price will stay the same. This can be useful because in a normal stop order, you set a price at which you want to, for an example, to sell a stock. Let's say you set it 5% below its current value. Well, if that stock for some reason jumps 10%, you have to then readjust your stop again so that it matches 5% below the current price. Anytime you get a good movement upwards, you would have to readjust that stop. This can be incredibly annoying, and a trailing stop fixes this issue. Let's go over an example so you can see what I mean. Let's say stock MHFN is selling for $100 a share. You think MHFN will rise in value, but you also want to help protect yourself in case it falls. You buy a couple shares, but you want to make sure that you get out and sell if the stock drops 5%. Perfect, so you set a trailing stop order to sell when the stock dips 5%. What this will do is follow or trail the highest price of MHFN. Remember I said it was currently trading at $100 a share. Your stop price will start at $95, which is 5% lower than the current price. In this scenario, if MHFN stays between 100 and 95, the stop price will remain at 95. If MHFN rises to, let's say, 110, the stop price will update to 104.50, 5% below the new highest price. If MHFN falls to the stop price at any point, RobinHood will execute a market sell. Essentially, a trailing stop is more flexible than a fixed stop loss order, as it automatically tracks the stock price direction and does not have to be manually reset like the fixed stop loss. The ideal trailing stop loss will change over time. This means you're making money and the stock is rising. During more volatile periods, a wider trailing stop is a better bet. During quieter times, or in a very stable stock, a tighter trailing stop loss may be effective. That being said, once a trailing stop loss is set for an individual trade, it should be kept as is. Thank you guys for watching. Please make sure you hit that subscribe button if you enjoyed, and if you're looking to sign up for RobinHood, please consider using my affiliate code in the description below.